Well, Neil, it's been a while since we did one of these.
Yes, good to be back, and of course we're back on a regular basis now.
Oh, well, let's have some fun doing it then. Shall we start with the economics?
Yes, a few things been happening as usual. I think the big story is that things are rather better than anybody expected. You might not think that looking at UK GDP figures, they slowed, retail sales figures aren't doing so well, but behind that I think there's the strength of business confidence which has surprised everybody, despite Brexit, despite Trump, despite everything that's gone on. Not just in the UK, across the world. Maybe the US lagging a little bit, but rather better. I think we're actually getting out of that very long recession we've had.
Shall we focus on Europe? I mean, we're hearing from the physical asset market that the capital out there is really buying into a European growth story. Do you think that's well-founded?
It's definitely well-founded. I think part of it is the US story. There's a bit of uncertainty there. I think that will change, but at the moment, yeah, Europe is the one that's had the biggest recovery. And the growth rates aren't phenomenal, but they're positive. There's a bit of untapped demand there. No development in most places, economy's picking up, vacancy rates going down, certainly in the office market. Logistics is another good one as well. Expectations of rental growth are very strong at the moment.
And this is being matched by behaviour. We're seeing good volumes, particularly in the core economies, in offices in particular. Logistics has just been flavour of the month for a long time, and that's matched in a lot of places. Matched in the UK, it's matched in the listed market, it's matched in Europe. Retail a little softer, again, pretty much where you look. And I wonder whether that's really a reflection of the fact that everyone's kind of bought into the fact that the world of retail is changing, and that therefore gives a little bit of extra risk around the whole retail environment. It's
been changing for a while. You know, e-commerce isn't new, but people appreciated it's really having a big impact now. I mean, not all retail is the same. We've seen prime high street retail do quite well. Still reasonably robust, but probably a bit of a growth spurt gone off that one as well. And it's come off retail, it's gone to logistics. It's two sides of the same coin at the moment. And that's the way it seems to be. I mean, interestingly, on logistics, the strongest market is probably the UK. You know, despite everything else, that's where we see these effects the most.
And looking at the index figures on that, one thing that really stands out to me is that whereas logistics industrial, depending on your index category, has been the strongest performer for some little while now, good strong first quarter as well. When you look at our prime index and our secondary index, the difference between the two is materially all in the logistics space. And so good quality is really doing well. And whereas it stands out in those numbers, we're seeing this in the appetite of capital, lots of money for good quality core assets. Things with a little more risk, maybe less so, and perhaps finding that match between capital and pricing a little more difficult.
Well, I think there's two things that are going on there. One is, I said things are better than expected. There's still a little bit, but I can't quite believe it yet. There's a bit of uncertainty in the UK. We had the referendum. We don't quite know how things are going to pan out. The economy has been doing okay, but a long way to go. Even in Europe, you still get some differences. What's going to happen next? We've got a number of big elections in Europe this year, after all, which has added a bit of uncertainty. Yeah. So people look to the prime assets, look to what they think is the more guaranteed income.
But this would also tie into this concept that we're in a longer, lower cycle with more moderate growth. Perhaps people thinking that you can't necessarily rely on a rising tide to float all assets northwards, and therefore they're just a little more guarded, underwriting a little more carefully and prepared to enter at the right price, but only at the right price.
Well, that's certainly the case at the moment, but maybe the UK has been a bit ahead in the cycle, but you go to continental Europe, there's so much money targeting continental Europe, you do wonder where is it going to go. Yields for the prime assets are incredibly hot. So, I do wonder if there'll be a temptation at some point to actually move up the risk curve.
Well, the other place we've seen people definitely going towards, and I'm experiencing this, at a very personal level on the engagements ones currently transacting in the alternative space, other asset classes, and the demand for that is absolutely rock solid and red hot.
It's a sign of expensive prime assets. You look for a better yield elsewhere, you search for income. Of course, it's harder to do. There tend to be smaller assets. There's a little bit, I wouldn't say there's necessarily more risk, but a little bit less understanding.
Different types of risk, operating risk usually.
Yes. So, that's another feature of it. But this all begs the question, of course, where do we go from here? We've got very hot pricing on prime assets. It's spreading elsewhere. A lot of it's down to, let's face it, down to very low interest rates. What's the threat going forward? Can this last?
Well, I mean, everyone talks. If you look about rising interest rates. And if you look at the Investor Intentions Survey, which we always do at this kind of time of year, the attraction of real estate has been net real income. And the risk that everyone worries about are twofold. One is rising interest rates, and the other one is something that turns the cycle. Now, I think my views on this have been fairly well covered, and I think we are in quite a moderate cycle, and I think that's got quite a way to run. But if you think about what can we take as indicators for interest rates? If you look at the 210 spread, the spread between the yield on 2-year government bonds and 10-year government bonds, that's currently around about 100 basis points. Now that's compared to an average, whether you look at median or mean, of about 145, even 150 over the last 5 years. So while everybody is talking about rising rates from their incredibly low levels, UK 10-year 1%, a tiny bit of change, those expectations per market prices, not forecast, only prices, are that the rates will rise more slowly than has averagely been the case in terms of expectations over the last 5 years. That doesn't point to me, in a longer, elongated low cycle, to a big risk of rising interest rates in the short term.
It doesn't. I mean, let's just look at it another way. I sometimes wonder if those sort of market prices are much more powerful in the shorter term than the longer term, and they might miss out a few things. But the economist's view has always been the threat is from inflation picking up for whatever reason. That happens, short rates move up, and you might get an atmosphere of long rates moving up too. The other feature of the current state of the economy is actually, now this might sound strange in the UK, but a marked lack of inflationary pressure. Now it sounds strange in the UK because obviously CPI inflation has gone up quite a lot, but what hasn't turned are average earnings. It's not feeding through, it's not creating an inflationary cycle. It's very, very true in continental Europe, where the core rates of inflation have hardly changed at all, even though the headline's gone up. The form of the pound has pushed the headline up even more in the UK, so it's not actually feeding through into any kind of even a muted inflationary spiral, or not yet anyway. So that makes policymakers look at these things differently. And the Bank of England has always got its eye on other things as well, but it says it's not worried about inflation. That's why. It's not that it doesn't care about inflation, it doesn't think there's a threat. The ECB is determined to give forward guidance, because it still thinks it's early stage recovery for a lot of Europe, keep rates low, but equally it's been reassured by the fact that rates haven't picked up. And that's been quite a big difference between this cycle and previous ones, or maybe it's a sign we're not quite at that stage of the cycle where we have these issues.
I think it's a sign that we're earlier in the cycle than some people imagine. And this isn't a Goldilocks where everything sort of stays just fine forever. I don't believe in that. I just think that if you look at the indicators in the economy that point towards those end of cycle and inflationary worries and so on, they're just not there. And what we are seeing in terms of inflation are not the sort of things that rising interest rates actually do anything about. So I think the risk on that is lower than some people would appreciate. Now, in terms of things that people might worry about, because frankly we've given a pretty sanguine view of the world for a little, as we have done for a while, and so far been borne out fairly strongly. What else are people worried about? There's always the sort of the elephant in the room. Everyone's relied on QE. Do you think that unwinding QE is a real issue in the short to medium term?
In a word, no, or at least not in the UK, not in the euro area. It's a real possibility in the United States. The new administration has got a rather different philosophy on this. And it was probably on the cards for the old administration anyway. The question there is how far, not if. But the ECB is certainly not going to go that way. It doesn't think it's no need to do that. And the Bank of England, again, is worried about uncertainty in the UK. It doesn't want to give negative signals. So it doesn't seem the time. I mean, when would be the time?
Naturally, it would be when a cycle's getting hot. You used QE to sustain it when it was really bad. You reverse it to take some steam out of a cycle. And I don't see the incentive to take the steam out of what is a moderate cycle. But maybe dogma and politics overcomes economics. Anyway, there's lots more to go on this, and I suspect we're probably going to have to keep that for the next time round.
I think we will.